Today at work, a coworker said that their financial advisor recommended Chewy for a position to take with the $5,000 that they had sitting in their accounts. So I decided that I wanted to take a look at Chewy and see what was going on there because a lot of analysts seem to like this stock. The 1-year target estimate is 25.23 according to Yahoo Finance here. And analyst recommendations, not a strong buy, really. 7 have held it at that. A buy, at least double digits, hold double digits. And then it looks like about 1 say that it underperformed. But then when it comes down to the actual calculation of the fair value, they say it's overvalued. I'm coming up with a fair value of 1053. That's off the discounted cash flows of 2265. And this here is kind of a worst case scenario. So the stock currently sits just north of $15 and is essentially at its 52-week low. Earnings yield looks low. They're on the cusp of profitability. 2020 and 2021, they were negative. They are just now going positive. So not the end of the world. Could be a potential growth stock. Cash flow yield 3%, kind of low. On average 1.1. They've had incredible growth in their cash flows. I wish that they grow it further. I mean, even if we say 6% off the 5.6% revenue for the thesis here, that gets them to 3.1 over the course of 5 years. Maybe they can grow a bit quicker than that. And if they do, this will help update the fair value. And how about 10% growth from where they currently sit up to 3.3 over the course of the next 5 years. And honestly, I hope that that is a low case and they can get it up to double digits. But we're being reasonable here based on what they've done previously. ROE looks pretty good. 7.76, right towards the lower end of what we like. ROI negative, so they're losing money on their investments. And ROA 1.24, not good at all. Their assets are not doing them very good. Debt to equity 5.25, very high in the debt. This is a really hard stock to pin things down on because if we look at some of these metrics, you can just see how crazy the growth rates are. Huge positives, negatives. There's such low numbers to start with. Back in 2020 was really bad, and they're coming out into profitability right now. So we do need to factor a bit more growth into there and give them a bit more leeway for that. But that debt to equity is very high. Margins, a little lower than we'd like to see. 28%, it's not bad. It's up from what they have had previously. I'd really like to see that above 30. Net margins, essentially flat. As you can tell, they're at break even right now. And 23% year-over-year growth in their margins would get them up to 1% over the course of the next 5 years. Now, I'd really like to see this get up to 10%, but I don't know that it's reasonable. It triple from where it currently sits to get to that point. And if that's something they are able to do, outperform on this margin growth, then the cash flows will grow with it and the valuation will be able to take off. So what we're looking at here, it's pretty clear, 5.5% or so growth analysts are expecting year over year. Kind of low. We'd like double digits, but maybe they can make up for that in other ways. Share count, they have issued shares in the past few years. Almost 1% per year is what it breaks down to, so we'll go with that. Cash flows, like I said, that 7% growth year over year would get them up to 3.3% cash flow yield in 5 years. I'd like to see them do better than that, but we'll put this in here for now, and then we will update it as time goes on. They have earnings. Assets, they've been growing them great. It's slowed down quite a bit, so maybe this 20 is a bit much. Maybe the 15 is more fair. And in the same vein, we'd take those liabilities down to 8, maybe 8.5. Dividend is non-existent, and margins, like I said, 23% growth would take them up to 1% net margins over the course of 5 years. So I'd say this is a reasonable case, probably more of a worst case scenario for the stock here. So 25% annual growth in the fair value of the stock. If this is what were to happen, it looks like quite a bit of that is being driven by the balance sheet. But you're starting from such a low point that 25.43 is not going to do a whole lot. I mean, like if we break it down to the actual fair values here, I mean, the cash flows are one of the main drivers. And I'd love to see them grow those cash flows faster. So how about we up that to just double digits, 10% growth, 3.8% cash flow yield, 26% average return, but you're still underwater on your position because based on the numbers they came in at in 2023, at a 20 PE ratio, this stock is worth 1.8, $1.80. If you take 20 times the free cash flow per share, which is considered to be a reasonable valuation for cash flows, you come up with about $16. So cash flow wise, price isn't bad where it sits. And then for the balance sheet, based on the assets per share, it's $3.55. So almost all of it is coming from those cash flows. Off expectations for this year, you get some growth in the earnings value, bringing it up $1 to $2.80, and then even more growth in 2025 when the earnings per share are expected to be 36 cents per share. This here would be more of a bullish scenario where they're able to grow those margins and those cash flows up to something more in line with some of the stocks that we've looked at. 5.1% cash flow yield. It's better. I mean, it's not amazing. Based on what they currently sit at, it's not something we've seen from them previously, but they've had some decent growth year over year in that cash flow yield. So, I mean, if they continue the trend of 1% growth in cash flow yield per year, that would be incredible. And in that case, we'd be looking at 6% for this. Ideally, in a scenario like that, they're able to bring their margins up as well. If they can get those up to 2%, you'd be looking at really good average returns. But still, it all depends on when you get into the stock. And if this thing's trading at higher future multiples, then the stock should rise with the fundamentals a bit better. I mean, looking at these PE ratios, they're insane all over the board. So, 20 is reasonable for the market. If this thing's only growing its top line by 5%, I don't know that a massive multiple is really warranted here. Their cash flow growth is pretty good, but still, that's not going to be able to continue forever if they can't fix that top line growth. So, look, I like the growth here. I don't think that the price is right as of yet. $10, I'd buy a bit. 15, I'm not a huge fan. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at and subscribe so you can stay up to date with everything. And I'll catch you next time.